Hi folks, Doc Severson here for the Theo Night Report for Monday, July 11th. I'll start out tonight's report on the S&P 500 Cash Index, or the SPX, and something that you don't see every day is right now we have a new all-time high and a new all-time closing high as well too. So that's not surprising after last Friday's jobs report, number one. Number two, the fact that there is literally no chance of a rate hike until later on this year. We'll get into that in just a minute. And number three, people over the weekend reading about all these reports and reading about the jobs report, and basically that momentum typically will spill over on a Monday, as well as the fact that all-time new highs tends to draw capital off of the sidelines as well. Not myself, but this is just what happens with funds as they have to hold their nose and chase performance. So before we go further into the S&P 500 and examine what happened today, let's take a look around the horn here and see what happened with the other indices. Here's the Dow Jones, and the Dow Jones is just hanging out right below those all-time highs. And so we got above the April high over here. So that was pierced today. However, we're still hanging out down below the May 2015 all-time highs on the Dow. Here is the NASDAQ composite, and we are way down below there. This has got a long way to go as the NASDAQ composite really got smacked so far here in 2015, 2016. After pretty much leading the market higher from here, the earnings have been less than impressive from this point. However, the price is now above the June highs, so we have some clear sailing until we get up to some of these intermediate highs as well too. And then we'll finish off with the Russell 2000, which is about 100 points still below its all-time highs from 2015. So long way to go before the Russell is able to overcome those. So watch this 1200 level on the Russell to see whether or not this thing has got the strength to be able to break out and beyond that. So that is a major resistance point right now in the Russell. Okay, so let's go back to the S&P 500 first, and let's just look at the spiders so we can see a little bit more in terms of actual volume, because this is one of the most heavily traded instruments that's in the stock universe that's out there. And what we can see is, kind of zooming in on this, we can see that a few things actually. First of all, the volume today was fairly low. 71 million shares is actually fairly low as it relates to the spiders. Certainly it's low compared to what we've seen recently. So you could kind of draw an analogy with, if you were down here and you throw a baseball as hard as you can, eventually it's going to slow down before it needs to make maybe a pullback or so here. So this is kind of an analogy to that. Is, not a very big bodied candle here, so not a whole lot of net positive above there. Still, it's a positive candle, but I don't like that tall upper shadow on this candlestick, as well as the way that we closed the day. We closed the day fairly weak. Now, with that in mind, however, I don't think we're seeing what's called a pop and drop. A lot of times what we'll see is markets that near the highs all of a sudden have a massive green candle, right? Massive positive candlestick here on huge volume. And sometimes that is a tip-off that this is just a rotation. This is distribution from the funds that are saying to retail traders, oh, would you like our shares? Here you go. And this is where a lot of times you'll see institutions selling to the retail traders at the highs because they're desperate to get out and kind of control their risk. We are not seeing that right now. We're not seeing a whole lot of distribution and rotation from institutional firms over to retail at this point. So what this tells me is that more than likely, I think the S&P is probably going to spend at least a little bit of time up in this area, maybe consolidating some of these crazy gains that we've seen over the course of the last week and a half or so. So a small little flag pattern here over the course of the next week or two maybe, before we see additional gains to the upside, might be a wise path for the market to take right now if, in fact, we don't want to see a quick trip back down into this zone. Now, something else that we're seeing on this chart as well too, and I'm going to pull these out so we can get a better look at them. What we have here is implied volatility in the light blue, and we have realized or historical volatility in the orange in this study down here. And so what we're seeing right now is what we typically run into in these types of markets where we have the realized volatility is actually outrunning what's being priced into the option chain. Okay, so that should tell you a couple of things. First of all, we don't want to be selling options during environments like this. This is typically a very bad time to be selling options because honestly, there's very little premium in the chain to be able to sell. So these are scenarios where you could literally sell a call spread and 2 days later you're getting run over, even though it's several months out or several weeks out in time. Instead, we are going to be net buyers of options, whether or not those are bullish moves to the upside or perhaps we're going to be taking moves down from here. Either way, we're going to be net buyers of option premium in the short term until we get a mean reversion here to make it more conducive to be able to selling premium. Now, something else that tells me that we're probably going to be trading within a small range here, at least in the near term, is the fact that the market has already priced in basically a zero chance of a Fed rate hike in the upcoming months, at least certainly before the election. If we look at the late July meeting, there's only a 1.2% chance that they will actually cut rates, 98.8% chance that the Fed will stand pat. As we get out to the next big meeting, there's less than a 6% chance right now that the Fed will hike, 93% chance that the Fed will stand pat. And then as we get into the 2nd of November meeting, do you really think the Fed is going to change any policy prior to Election Day? I very much doubt it. This is why we're still sitting there at a 6% chance of hiking rates at this point. And that, of course, spikes up to 22% as we get to the end of the year. This is the last major meeting. Typically, they don't like to make major policy changes at the end of the year, around midway through December. However, the election's out of the way. There's a new administration in place. This is where, at this time, if we still have an economy that is growing in tune with the jobs report that we had last Friday, then perhaps even the 22% chance is about the right number there. What this means is right now, the CME and the market is anticipating and interpreting this data that the Fed is out of play for the next several months. Hallelujah. So that's the longer term risk as it relates to the Fed. However, that doesn't mean that we're not going to have some short term jawboning, just like what we had back in May when they started flapping about how they wanted to raise rates. And then all of a sudden the numbers that came out right after that, as well as the Brexit issue, pretty much torpedoed any rate hike talk that they had. But notice how many of these that we're going to have to deal with over the course of the next few days. All of this in bold here is FedSpeak. This is where any Fed governor or president that's anywhere near a microphone is going to be doing their best to jawbone the market and do whatever is the party line, which frankly we don't know what it is this week. So if this goes along with this narrative that we're not going to see any rate hikes until perhaps later on this year, then the market will receive that positively. Basically, this is what's already priced in based on today's information. If, however, they get to be more hawkish and start talking about perhaps raising rates earlier than that against what is priced in at the CME page, then we may see more of a negative reaction, which in this case, a negative reaction is probably going to be nothing more than more of a pullback versus a consolidation. And that leads us to our next risk event that we're going to need to start watching for, which is second quarter earnings begin this week. Actually, aftermarket today starts with Alcoa. So you can see some of these as we get into this. We have the Alcoa aftermarket, so that's probably already reported by now. And we'll know the results of that in just a few minutes. As we go through these, some of these days, we're going to start to run into some of the major market moving stocks, which, like Yum Brands, is on Wednesday. So we'll watch for that one. All right, so on Thursday, we've got JP Morgan before the market open. Okay, so that's going to be a big one. Then on Friday, we've got Citigroup as well as Wells Fargo. So we have three major banks reporting this week. So that's going to be a lot of the major market moving issues that we're going to be watching for. Most of those are pre-market. A lot of times the banks will report in the mornings. Now, again, this time of year, we get into this whole, is good news bad news, or is bad news good news kind of scenario. And so right now we have priced into the market based on today's information. We are anticipating negative 5.6% earnings growth for this quarter. This is what's already priced into the market. And this is several quarters in a row that we're running with negative rates, negative earnings, right? So if those numbers end up coming out better than negative 5.6, again, this is where you get into bad news is good news kind of thing. And you would expect to see the market respond very, very positively, albeit perhaps in a more grinding fashion, but you would expect to see any kind of number that's above negative 5.6 received as market positive. Again, right now what we're dealing with is an earnings recession, but we're still the best house on a bad block when we're talking about the global world, which is going into negative interest rates and all sorts of stimulus. And right now, we're not doing that. So this is to a large degree why we have not sold off at this point, because in the eternal search for yield right now, the only place is in the U.S. market. So regardless of the fact that we have negative earnings growth right now, again, best house on a bad block. That's why the money continues to roll in. And this is why we've set S&P all-time highs today. We are anticipating consolidation, so we'll see if we set up a trading range this week, and then we'll report based on that. Thanks for listening, folks. We'll see you tomorrow.